morning. Welcome to ET Now. I just wanted to analyze what's the mood on India post the budget. Has it done enough to bring any of those $22 billion of outflows from FIIs and FPIs back into equity markets here?
Thank you very much, and good morning to yourself and all your viewers. Not quite, I would say. I think the global context is actually pretty important. In spite of all the headwinds and global macro worries, our recent discussions with investors show that emerging market funds are actually seeing record amount of inflows, right? And to the extent that they're not seen for a long time. But somehow the love towards India is kind of missing. And I think that's, if you look at a month or 2 months of foreign selling data, it's kind of visible. I think, usually the budget, it's over the years has stopped being a very big market moving event, because a lot of other decisions get taken elsewhere. But I think what kind of worried the markets yesterday on the headline number was the higher taxation for derivatives, securities transaction tax. It's coming at a time when India has underperformed, and foreign investors have been pointing out the higher capital gains tax in India, and you actually see a higher taxation coming up. Other than that, I would say the fiscal math itself, I think the only point of worry is where, is about the higher borrowings number, that's being budgeted. That's especially given the situation where a lot more of the borrowings are actually at the long end. It kind of matters for equities valuations as well. But otherwise, they've been reasonably conservative in terms of many of their assumptions in terms of growth for the economy, in terms of tax buoyancy, in terms of what needs to be done to bring down the fiscal deficit and so on. But yeah, you could argue it was sticking to a very tight script, but probably the market would have expected something more.
Sunil, if you look at what the street was looking from capex, it has been delivered by the finance minister, either as part of the whole capex story of 12.2 lakh crores, or defense capex being up by nearly 18%. You still feel that there is disappointment because of that? Because the capex story continues for India in that sense.
So yes, capex, public capex is one part of capex, right? That's not the only capex that you need to look at. But I think I wouldn't say it's a disappointment. It's kind of in line with what the street was expecting and what our own UBS expectations were on. I think there was some expectation heading into the budget as well. Defense is particularly one place where globally there is a lot more spending happening. Not just here in India, but starting from the US, Europe, etc. So I think those were expectations that were reasonably baked in. And what you got was something unexpected lines. So probably that's where some of the disappointment was. For us it's in line. So the defense numbers are in line.
What about roads and highway and railways? There too, you have double-digit capex coming in.
All I would say is that these sectors have seen meaningful focus and thrust from the government post-COVID. There was probably a year or so of a bit of a pullback, and now it's come back. It's good, but it's we also need to see where these stocks are, where the valuations are, and so on. It would probably say that it was in line with what was kind of being expected on these companies. So it's good. It's good to see some of these numbers being coming back in terms of government focusing back on growth. But yeah, we would say that's something that was probably expected as well. As I said, it was largely in line with what what our economists and our industrial teams were actually expecting.
So, Sunil, I just want to get back to the point that I was trying to dig at earlier. What will change India's risk reward for global funds to come back?
Okay, so if you actually look at India in a global or an emerging markets context, why is it that funds are struggling to deploy, funds are struggling to find value and in putting into India? Um, some of the hot narratives that are driving up some of the other markets are mostly missing from India, right? So, I mean, in some of the other North Asian economies, you have frontline AI companies, AI stocks who have AI products, their own foundation models, they have their own consumer-facing products, or they are part of a supply chain well entrenched in supplying stuff to US hyperscalers and so on. And if you actually see what's basically been driving up the EM or Asian markets over the last 12 to 15 months, it's essentially been AI, right? So that's something that we've kind of missed out on. Uh, Even outside of AI, over a 6 to 12 month basis, India's earnings trajectory has not been too strong, right? I mean, I think it's broad based. It's not specific to a particular sector. So I would say, a sustained turnaround and growth in earnings is a necessary condition. I'm not sure if that's a sufficient condition for India to start outperforming. Um, what we've also seen is that, I mean, we have seen episodes of foreigners selling in the past as well. I mean, if you actually look at a cumulative 5 year period, foreigners have actually net sold out of India, right? But still, the market did well in the first 3 or 3.5 years of this 5 year period because the net domestic flows into the market was actually fairly good. What we're now seeing is a combination where the domestic flows into the market are not going stronger anymore. They kind of hit a peak, and there are months when you actually see mutual fund flows are a bit tad weaker and so on. But couple that with the fact that there is a long and large pipeline of capital raise and IPO activity as well. I think that's what has actually also caused the change. From a valuations perspective, in our view, India is still expensive. Historically, India was at a 20-25% premium. That's pre-COVID to rest of EM. It touched almost 100% premium in late 2024. It's still now at a 55 to 60% premium. And the growth rates that you're expecting, even consensus is expecting for the next 2 years on earnings growth from India is not very different from what you get from the rest of emerging markets, because of the other factors that I mentioned earlier. So, which is why you either need to see a much more meaningful correction in valuations relative to other EMs, or a serious pickup in earnings. And not sure if the budget as an event alone can really kickstart that earnings recovery cycle.
Sunil, I wonder, with regard to flows, if they were to reverse, if FI flows were to reverse towards India, will it be to the traditional sectors, IT, banks? Will those be the typical beneficiaries of financials, frankly, within the larger banking and financial basket? Or will it be certain other sectors which might well also be of interest to FIs?
Well, okay. So if you look at the index and look at the size and look at the places where foreign ownership is kind of high, I mean, you do have banks, consumer, and IT services as generally the large, liquid, well understood businesses with good corporate governance, which FIs are comfortable with, and so on. So I mean, I would, and of course, banks on our screens at least are one of the few sectors which are cheaper than their own history, still cheaper than their own history in India. Consumption in particular staples are in line with their own history. Most other sectors are more expensive, right? So I think you would see the traditional sectors that you mentioned as the first port of call if the money comes back.
Sunil, how do you look at some of the public sector banks versus private sector banks valuation now? We've seen PSU banks outperforming. There has been some correction because of the excess government borrowing, which is going to put some pressure there. But from a valuation point of view, do you see the valuations converging at some time because of the kind of rally we have seen in PSU banks?
Well, look, the preference is clearly for the private sector banks. From a bank's team. Yeah, I mean, I think the kind of headwind that could be from the bond market or the bond yields is a lot lower. Most of them are done with whatever NIM pressures had to be there. There aren't too many asset quality risks that we are, really heading into, at least for the larger banks. So yes, so there are. I think the preference is clearly for the private sector banks rather than the SOE banks.
Sunil, what is it that you're making about, what's going on within the commodity markets? And I'm not just talking about, the last 2 days of a crash that one has seen, but the fact that it's actually multi-asset allocation as a strategy, which really worked out all through last year and continues to play out right now as well. Do you think that's also kind of making equities a little less attractive? And I'm only talking about India here.
If you throw in commodities into the question, you can no longer talk only about India, because you're talking about global signals as well. So the fact is that, I mean, commodities prices have been doing well, and stocks which are linked to those commodities have also generally been doing well. And I'm making a general global comment at this point. So UBS has been reasonably positive on gold. All through the last 15 months or so, and our gold strategists still see some further upside. But on all other commodities, it's a very selective view, right? I mean, one of the largest commodities that matters for global economy and for markets is oil. We don't see a big upside. If at all, that could be, a very minor downside, given what's happening on geopolitics. For the other metals, it's again very selective. I mean, there are some sectors and some metals where, we have seen, either the end industrial demand dynamics changing, or some incentives changing in some of the developed markets. Incentives being taken away for electric vehicles and internal combustion engine vehicles, coming back into the picture. AI data center rollouts is causing some of these commodities to rally and so on, but not a whole lot for instance on a base metals and iron ore, etc. We're not super positive. So I think it's very selective over there. If you're specifically talking about gold, which had seen massive volatility over the last week or so, UBS still sees some upside, but not a whole lot.
Right. Okay, Sunil, so good having you on the show. Thanks for all that insight. Good speaking with you.